Thanks for joining us on the first edition of Power Lunch in 2019. This is Bloomberg Quint. I'm Harsha Subramaniam. The headlines at this hour. Markets start 2019 on a cautious wicket. Liquor stocks fall after reports that Maharashtra will raise tax on Indian-made foreign liquor. The Securities and Exchange Board of India makes physical settlement of stock derivatives mandatory, but the shift will happen in a phased manner. The RBI expects bad loans in the system to fall by March, but warns against high MSME loans growth in its financial stability report. Maruti Suzuki ends 2018 on a somber note, total car sales falling more than 1% in December. Thanks for joining us. Quick check on how the markets have been faring. There is caution in the air as on the first day of trading in 2019. Yatin is here with a closer look of some of those stock movers. Yatin.
Good afternoon. It's not a happy year so far for the markets. We have started the new year on a weaker note, almost 40 points down on the Nifty. Of course, if you look at the market breadth also, the advances are almost 14 advances, 236 declines on the Nifty. So clearly, we have nearly 2/3 of the stocks on the declining phase for trade today. However, if you look at some stocks and some private banks like Yes Bank, Axis Bank, all of these stocks are gaining anywhere between 1–1.5%. Also, we have some pharma stocks which are showing strength. So the likes of Sun Pharma, Lupin, have been doing well in the start of the year. If you look at the metal stocks, they have started on a weaker note. So we have the likes of Hindalco, Tata Steel, SAIL, all of these stocks down 2–2.5%. Also the likes of Mahindra and Mahindra, that is down 1%. And let's pull up the auto stocks for you. Today Maruti reported their numbers and they have ended 2018 on the weakest note. So the December monthly sales are the weakest in 2018. So clearly the momentum in auto stocks has been broken down with all of these stocks falling. So we have Mahindra and Mahindra, Tata Motors, Maruti, all of them correcting in trade, and everybody's awaiting the monthly sales numbers. So we'll watch out for that. Apart from that, in the mid-cap space, Dredging Corp is one stock which is active, 7% up for that one. There have been murmurs of divestment and a strategic partner coming in. Hindustan Construction Company, MTNL, these are the few stocks in the mid-cap space which are on the gaining side.
Well, weak and cautious opening for the first day. Thank you, Yatin, for that. It's the first day of 2019. Investors will surely be hoping that this year pans out to be better than the last one. Yesterday, we got you what expert had to say about the Nifty and the factors at play. With which sectors will take it higher, and what particular stocks are likely to lead the up move? Darshan is here with the second part of the poll conducted by Bloomberg Quint among market participants, 27 market experts at that. Darshan, what are they betting on?
Yeah, so yesterday, as you pointed out, it was on the market. Today, it's about the sectors that they like. These are the sectors that, that market participants like. The first one being the private banks. So among the 27 participants, we told them to name 3 sectors which they believe will outperform and underperform. In totality, majority of them, if you tabulated, private sector banks was something that they liked. IT, again, a defensive play is something that they like. IT and FMCG, both of them there. Surprisingly, capital goods, a lot of them do believe a recovery can happen. And oil and gas is something that, a lot of analysts do believe that could come in. Now, surprisingly, 2 of these sectors also feature in the sectors which actually need to be avoided. So you have oil again, and you have IT again. So it's split wide open in terms of where it could go in. But metals and sugar, so basically commodity related stocks are something that should be avoided. They don't believe it's a cyclical uptrend this time around. And auto, you just heard the auto sales number that come out, that's been disappointing. So auto as a pack is losing sheen. Which are the stocks that they spoke about in the poll? And we did a tabulation on the stocks that we asked them to name 3 stocks they believe could outperform. And once we tabulated them, these are the numbers that came out. Actually, BFSI is something that had the maximum hit. So Axis Bank and ICICI, both of them leading the rally, and both of them have done well. Among the private sector banks, Kotak Bank and RBL Bank, which are basically on the retail end, and you have the Bajaj Twins as well as Canfin Homes on the NBFC side. So these are the stocks that came in on the NBFC side of the markets. The other stocks which again featured among the list include counters like an L&T, JSW Energy. Surprisingly, despite the spot energy rates going down, it's a bullish bet. Petrent LNG, because of the Kochi terminal that will come in, that is positive. Oil and gas, again Gujarat Gas. Siemens, again we've seen a strong set of numbers that came out and a recovery on the capital goods side. So Siemens and Piramal Enterprises make up the list of the other stocks that feature among the recommended one. And among the large caps which people like, HCL Tech, again on the IT front, ITC, a lot of them recommended. They believe this will be the year of ITC, Titan, Dabur, and surprisingly Bharti Airtel, despite all the issues on the telecom side, finds favor on the buy side with a lot of market participants.
Okay, these are the picks for 2019. Darshan, thank you so much for that. Let's go back to that story on auto sales. And we're talking about Maruti Suzuki and the fact that the sales fell for the second straight month in December. In fact, numbers were the lowest in all of 2018. Yatan is back with us to tell us what the pressure points for Maruti are. Yatan.
Harsha, if you look at the third quarter, which is basically dominated by the festive season, plus there were discounts which are at record highs, because all these factors were in place. We had expectations that there would be some cheer, but probably the December auto sales point out something else. So far, Maruti has come out with their monthly sales number, which were down nearly 1.5% on a year-on-year basis. So almost a flattish kind of a growth is what we saw for Maruti Suzuki. In fact, if you look at the mini segment and the compact segment for Maruti Suzuki, there we have a strong decline coming in, double-digit for the mini segment and compact segment, which has been doing well for Maruti with models like Brezza and Baleno. That segment is down nearly 4%. So on an overall basis, clearly we have seen some tapering off coming in, and despite higher discounts being offered, nothing is really working for the passenger vehicle segment, and that is what precisely we were expecting for the month of December, wherein a flattish kind of a growth trend is expected for the passenger vehicle segment. If you look at the estimations for the commercial vehicle space, also we are expecting a strong double-digit decline. Of course, the base last year was quite high. Plus, we have a 35-40% kind of a growth for the first 7-8 months of this financial year. The general sense is that the commercial vehicle sales would be declining, especially for Ashok Leyland and Tata Motors. Plus, if you look at the silver lining, that would be the two-wheeler space, wherein we are expecting some bit of growth coming in. For Bajaj Auto, strong double-digit growth is expected on the back of strong export markets as well as good domestic volumes. TVS Motors also, we are expecting a 13% kind of a growth there. However, if you look at Mahindra & Mahindra automotive segment, despite the new Marazzo launch, probably the passenger vehicle segment would be slightly under pressure. However, the overall numbers would be higher because of the light commercial vehicle sales growth, and similar is the case with M&M tractor sales, wherein we are expecting a 10% kind of a growth on a year-on-year basis.
Interesting that, Yatan, thank you. That's the automobile sales and projections for next year. Let's talk about aviation now. Interglobe Aviation, Jet Airways and SpiceJet are gaining in trade today after the government announced a 14% cut in aviation fuel prices. It's the steepest cut since November 2008. Samit Sarkar is standing by with the details of what this means for some of these airline companies. Samit.
So if you see, jet fuel prices have been cut for the second consecutive month, and in the month of November they have been cut by nearly 14% compared to last month, and on an average the prices have been around close to 59,664 rupees per kiloliter for the month of November. Now this has declined by nearly 14%, which is the sharpest cut seen in the ATF prices since November 2008. Now, however, if you see year on year, the prices are still higher, marginally higher by around 0.6%. Now, lower fuel prices will definitely benefit the aviation companies, but because fuel accounts for nearly 1/3 of the total operating cost for an airline company. Now, lower fuel prices will give some relief to aviation companies because that gives them the margin to hike air ticket prices, and also it will benefit the consumers because this will bring down the ticket prices in future. So all in all, it's a benefit and positive for the aviation sector, and that's the reason we are seeing a positive move coming in from all the three aviation companies, that is Interglobe, Jet Airways and SpiceJet today.
Soumya, thank you for that. The market regulator has meanwhile issued a new framework for the stock derivative segment that makes physical settlement mandatory. According to a SEBI circular, stock futures and options which are currently being cash settled will move to a physical settlement in a phased manner. Sajid is here with more details on the significance of this move and its impact. Sajid.
That's right, Harsha. Last April is when the market regulator, came out with this intention to move cash settlement to physical settlement in the F&O market. And as part of that, in August, they came out with a list of nearly 46 stocks, which was primarily to weed away some of the illiquid F&O stocks as well. But the regulator was very clear that over a period of time, the market would move towards physical settlement. And on December 31st, they came out with a circular giving out the timelines for how it will be moving into that. According to the circular, the stocks which are in the F&O, which is nearly 200, have been categorized based on market cap, and the last 50 will move first to the physical settlement in April, followed by the next 50 in July, and then the last 50 in October. Now these three would by end of October you will have the entire market in the physical settlement mode. Any stock which will be added to the F&O segment will be now in a physical settlement mode. That's what the regulator said. But it has a couple of complications here. One, that even though the Indian market is going to transition into physical settlement for derivatives, you have a cash market which is there in Singapore. And that would become a little more tricky because many of the foreign investors who are looking at cash settlement will now move to Singapore because Singapore launched 50 stock futures. Though the volumes are very minimal, it's expected that once this arbitrage or this regulatory arbitrage which comes in here, there would be some transfer of volumes going there. The second part which is there is the STT. The STT is on physical settlement is same as delivery based settlement. That means that it goes up by 10 folds for people who are going to do a physical settlement at the end of the contract. Now that would mean either investors will square off, or they will roll over, or they will not go for physical settlement because the cost or transactional cost becomes very high for them. And the third part is the SLBM, which is the securities lending and borrowing mechanism. Now the regulator has been working for last few years enhancing that mechanism so that it picks up, but it hasn't picked up because you don't see much of institutional participation from insurance and mutual funds. Now these participation are important for physical settlement to work. Along with that, if you bring in some rationalization of STT, then only you will see the volumes improving. Otherwise, you will going to see volumes declining, as we saw in the 46 stocks which were initially moved to physical settlement.
Okay, that's the larger story. This is going to happen in a phased manner, as Sajid points out. This will take up to October of 2019. Let's move on. The financial stability report released by the Reserve Bank of India projects a fall in bad loans by the end of this financial year. RBI pegs systemic non-performing assets at 10.3% in March 2019. However, the regulator does warn of risks from high MSME loan growth. Vishwanath Nair joins us with key highlights from the report. Rishi.
So yes, the NPA number is projected to be lower by 2019 March, and that's something that is a bit of a surprise, considering in June, when the RBI came out with the first installment of this report, of the financial stability report, it had actually projected a much higher NPA ratio. They'd said that about 12.9%, that's what we're going to end this year at. So that revision is heartening. But immediately after that, the Reserve Bank of India in the report points out that there are concerns regarding capital with these banks. Not taking into account any kind of government infusion, they believe that a lot of the public sector banks, especially most of the banks under PCA, will not be able to meet the minimum regulatory requirement. And that is a cause for concern, because if they are not being able to meet that regulatory requirement, means A, they will continue to be under PCA for a while, B, they won't be able to lend to even the sectors that they're allowed to lend. And see, the protection against the current lot of NPAs, that will be become a problem. So, all of these issues are something that the RBI keeps highlighting. But on the flip side, the government has, since we remember it happened only a few days ago, has said about 41,000 crore of additional capital just this financial year. So that will add some firepower to these banks. But the RBI's assessment on that is silent, of course, considering that the assessment was done before the government announcement actually came in.
Correct.
Another point, and that was something that you mentioned at the beginning, was about the MSME growth. Now, according to the RBI, banks, and in those public sector banks, and even in those the PCA banks, are some of the worst performing banks when it comes to MSME growth. However, they are also the banks which have seen the highest amount of MSME growth. Remember, in October 2017, when the government announced that 2.11 lakh crore package, they had said that this will be given on the basis of you doing more MSME loans. And therefore, there was a pressure on banks on doing those loans. But the RBI believes that this growth must have come at the cost of lower credit risk standards. That is primarily because just in the 1 year, just in FY18, banks, PCA banks saw at least 2% of their loans going into NPA. The loans that were given that year turned into NPA within 12 months, and that's about 2%, which the RBI believes is a very high ratio. So they feel that going ahead, the banks will have to improve their standards, will have to give out better loans, and probably this blind forcing of one sector focused lending is not such a great idea. Okay. So essentially that.
Rishi, thank you so much for that. I'm going to talk about the Tata Group now. The Tata Group saw its listed universe add a little more than 82,000 crore in its market cap in 2018. While this rise by itself may or may not be startling, what might be of concern for Group Chairman N. Chandrasekaran will be its reliance on TCS. The IT major had little company from some of the larger conglomerate companies like Tata Motors or Tata Steel. Samant is here to tell us just how much is the group reliant on TCS, and particularly the case that was in 2018. Samant.
So if you see, this is the first time that the combined market capitalization of all Tata Group listed companies have crossed the 10 lakh crore mark. But if you see in 2018, only 8 out of the 28 listed Tata Group companies have managed to contribute to this gain now, which is the lowest since 2011. Now, out of these 8 companies, one is TCS, and if you remove the market capitalization gains of TCS, then the other 27 companies have seen a fall in their combined market value. Now, TCS market cap increased by nearly 1,94,000 crore rupees, while the market cap of other 27 companies declined by close to 1,12,000 crore rupees. Now, this disparity in the market value of TCS and other 27 listed Tata Group entities has increased to such an extent that now TCS market capitalization is more than 2 times the combined market capitalization of all the other Tata Group entities, and this is for the first time, at least since 2004, that we are seeing such kind of disparity between the market capitalization of TCS and other 27 listed Tata Group companies. So this shows you the kind of dependence that Tata Group now has on TCS. Now in 2018, TCS market capitalization was close to 7,11,000 crore rupees, while that of other 27 listed Tata Group companies was close to 3,35,000 crore rupees. Now among the top gainers for Tata Group in 2018, we have TCS, which saw an increase in market capitalization by close to 1,94,000 crore rupees. Now this is followed by Titan, which saw an increase in its market cap by only 5,700 crore rupees, and then Indian Hotels, which saw an increase in its market cap by close to 2,800 crore rupees. Among the losers, Tata Motors, which saw a massive drop of close to 83,000 crore rupees, followed by Tata Steel and Tata Global Beverages in 2018.
Interesting. So what were the factors that influenced these stocks? Minus TCS, of course.
So I'll start off with TCS actually first. For TCS, if you see, it was the higher growth rate, rising share of digital business, margin expansion, and 6 corporate actions to reward shareholders, which aided the rally in the share prices of TCS. Now, company's revenue grew at a faster rate when compared to its nearest peer, that is Infosys. This, coupled with rupee depreciation, aided the EBIT margins of the company. Now, the company's revenue growth was partially aided by this digital segment of the company. Now, lastly, the corporate actions. Now in 2018, TCS announced 4 dividends worth 44 rupees per share and a buyback and a bonus issue, which all supported the share prices of TCS in 2018. Now for Titan, well, the start for the year for 2018 for Titan was not that good because of volatile gold prices and because of a possibility of an import duty hike, but it picked up pace in the later part of the year because then there was no import duty hike that came in. Plus, the jewellery sales volume and watch sales volume picked up in the second quarter of financial year 2019, for Titan. And more importantly, if you see the management commentary regarding the Q3 outlook for Titan was very positive that the company gave after the second quarter earnings. For Indian hotels, it was favorable demand supply dynamics, pricing power and operating leverage that aided the rally. Now demand for hotel rooms of Indian hotels increased by nearly 4 to 6% as against a supply growth of only 3%. Now this gave the company pricing power, which in turn boosted the company's operating margins in 2018. Now on the losers, I'll start off with Tata Motors. Now it was the headwinds faced by JLR unit of Tata Motors, which resulted into double rating downgrade that worked against the company in 2018. The sales volume of JLR slowed down and in fact declined in the first quarter and second quarter of financial year 2019. Now, the company also reported two consecutive quarters of losses, which prompted S&P to cut its rating twice in 2018. Now, post the second quarter earnings, the company did give a turnaround plan for JLR, but another rating agency, that is Fitch, said that the turnaround plan won't be enough to lift the ratings pressure that Tata Motors has been facing. For Tata Steel, despite a rights issue which increased the number of shares and the company's market capitalization, but the company's market capitalization fell. Now, what led to this? It was a double whammy of falling steel prices and rising raw material costs that impacted the share prices. This, coupled with trade wars, also weighed on the share prices of the company. Along with this, an expected delay in completion of its joint venture between the Tata Steel Europe and Thyssen Group and a higher debt to acquire Bhushan Steel assets also worked against the company in 2018. Lastly, Tata Global Beverages. Now, poor tea and coffee plantation and a weak domestic and international tea business weighed on the company's financials in 2018. A lower crops plantation resulted into higher tea prices in 2018. This, coupled with competition, weighed on the domestic business of Tata Global, while on the international business, the growth slowed down because of declining black tea market and an extended summer seen in the international market.
Sumit, thank you so much for that. I'm going to focus now on mutual funds. The mutual fund regulator will reclassify stocks based on their 6-month average market cap. Mutual funds will have to adjust their holdings or be reclassified according to AMFI's list of large, mid and small cap stocks very soon. Yash Upadhyay is standing by to tell us the rationale and, more importantly, the implications. Yash.
Afternoon, Harsha. So, SEBI, in order to ensure uniformity in the investment universe for the mutual fund industry, had set out clear-cut guidelines in terms of the market cap for large cap, mid cap and small cap companies earlier in the year. Now, this would be a list of companies which would get updated biannually, wherein the top 100 companies in terms of their 6-month average market capitalization would be considered as large cap stocks. The ones from 101 to 250 would fall under the mid cap category, and from 250 onwards would account for the small cap stocks. Stocks to keep in focus because of these changes in the mutual fund classification, which would come into effect for the period of January 1st to the 30th of June 2019, would include the likes of, in the large cap space, would include the likes of Berger Paints, which could make its entry into the large cap space, along with Divi's Lab, GSK Consumer, India Bulls Ventures, L&T Infotech, Page Industries, as well as United Breweries. What would make their way out of the large cap space and into the mid cap category would include the likes of Aditya Birla Capital, Bharat Forge, BHEL, Shriram Transport, Sun TV, as well as TVS Motors. What makes their way into the mid cap category, along with the stocks that move from the large cap, would include the likes of Aarti Industries, Alembic Pharma, Atul Limited, Bata India, Gujarat Fluorochemicals, Mahanagar Gas, Mahindra CIE, and a whole host of other names. What makes their way out of the mid cap list and goes into the small cap include the likes of Arvind Limited, Avanti Feeds, Dilip Buildcon, Engineers India, India Bulls Ventures, GM Financial, L&T Infotech, Rain Industries, as well as Reliance Capital.
Yes, thank you so much for that. The Modi government has missed its own target to electrify every village in the country. The Power Ministry, which had preponed the target by 3 months, has put out a statement admitting that 1 million homes are yet to receive electricity. Anindya Upadhyay of Bloomberg News now joins us more on this story. So, where are these villages located and what's the government's rationale for the delay, Anindya?
So, indeed, the Prime Minister Narendra Modi had given his government a target of electrifying 40 million households, and that target has been made easier and downsized to 25 million households already. And of course, as you said, that the deadline to meet this self-imposed target was pushed forward to December 31, and yesterday, December 31, the government issued a statement saying that they have not been able to meet even this pruned 25 million household electrification target, and they have only been able to connect 23.9 million households, which means over 1 million households still need to be connected to the electricity grid. Now, 4 states, Rajasthan, Chhattisgarh, Assam and Meghalaya, were the laggards, and they were named as those which have not completed electrification. Interestingly, the statement said that UP has completed 100% electrification, and that the government has launched a new campaign to identify households which have not yet been electrified. However, now it's kind of interesting that power is an interesting agenda in India's politics, and a lot of elections are fought on this agenda. And in 2019, as BJP and Prime Minister Modi go into elections, the success of this electrification promise could help them a lot. Finally, experts tell us that just connecting households with an electric connection is probably just an easier and the first step. The more difficult challenge, the more difficult step that's going to follow is ensuring 24/7 supply, which follows from here. Back to you.
Anindya, thank you so much for that. That's the ambitious electrification target. China is seeking talks with India to push a regional free trade agreement. Sources tell Bloomberg News that China is keen on concluding the pact in 2019, but India has a few concerns. Shruti Srivastav joins us with the details on this one. Shruti, what are the sticking points?
China has sought bilateral dialogues with India to allay its concerns on the RCEP, the Regional Comprehensive Economic Partnership, which involves 16 member nations. Now, China is keen to push for conclusion of RCEP deal by end of 2019. However, India has been one of the biggest hindrance in actual negotiation of RCEP. India has concerns that once it signs the deal, it will be flooded with cheap Chinese imports. So therefore, India has been trying to get a special arrangement with China, wherein it has to give access to fewer goods from China, which will have zero duty. Similarly, it wants a longer period for phasing out these duties compared to the offers which are being made to other member nations. Now, China is keen, before the RCEP negotiations go on in February, the intersessional ministerial meeting, China wants to allay concerns of India. India has also sought several meetings with key RCEP members, wherein it wants to build consensus on its demands of free movement of skilled professionals. Now, that has also been a key demand of India, because India has huge strength in its IT sector. Now, one has to see how the meeting goes in January, when the two parties, China and India, are likely to meet.
Shruti, thank you so much for that. Out of time on the show. Thank you so much for joining us on Lunch.